So what I wanted to do now is illustrate to people four different scenarios based on what people may potentially put into this kind of account on a monthly basis. And we are going to start really small with $1,000 a month. And we're going to extrapolate that over the course of somebody's life, and then we're going to move all the way up to $10,000 a month. And let's see what happens, man. Let's go through the numbers and see how this adds up.
And see, one of the things, just to back up for about 2 seconds, is just to kind of point out, you'll notice that what you're looking at, it says life insurance. That's enough to get most people to fall off their chair. Because traditionally speaking, when they think of life insurance, they're saying, well, wait a minute, that's not an account. That's something I get in case I die and croak and, that sort of thing. I wish we can call it something else. This is why I coined the term, let's look at this as a financial instrument, because although, yes, it was originally designed to protect families, for risk mitigation, that in the event that, God forbid, something were to happen to, to someone, that their loved ones will be provided for. That's not what I'm using this for. So the fact that you're getting life insurance out of it, consider that to be icing on the cake. Because
it's the cherry on the top. It's not actually what it's being used for.
You got it. And as a matter of fact, Mike, one of the things that I've sat down with a lot of folks to say to me, hey, look, I don't know if I need life insurance. And I said, you know what, you probably don't. But I'm going to show you why you want as much as you can get. Because believe it or not, there is going to be a limit on how much you can buy because of insurability factors, and it's tied into net worth. So let me just point something out. All the bullets that I talked about before in terms of the tax benefits and everything else, life insurance is probably the only vehicle that allows you to do that. So let's put some numbers to it, and then I'll explain why that is the case. So here's a perfect example. And by the way, let me point out one thing. The intent here is not to sell life insurance. In fact, I could care less if there's life insurance. And yes, as you put it, it's the cherry on top. So what I'm doing legally is giving you as little life insurance as possible and maximizing the cash accumulation aspect of it.
Before you get into that, why don't you give people a little history on how this methodology came to be? Because years ago when I got out of college, you walk into the New York Life office and they try to sell you life insurance, and you're like, man, I remember hearing years ago that's got to be the dumbest thing you can do. But this has evolved, and thanks to the economic climate we're in, the tax laws that we have now, I know for a fact that this is a major vehicle for Donald Trump, because I know the guy who runs this account for him. So if he's taken advantage of this, that obviously caught my attention. And if someone like yourself is using this with all that you know and all that you've been able to accomplish financially in your life, there's something else about it. So how did we get to this point, and how did you discover this?
I think a turning point, first of all, I think it's important to point out that this actually even goes well beyond the Donald Trump era. A lot of the old money, you'll have, and we can name famous family after famous family, how they accumulated wealth through their different businesses and so forth. But the way they perpetuated this also, the life insurance component definitely kicked in. But in answer to your question, in the 1980s, for those folks old enough to remember the E.F. Hutton commercial, saying that when E.F. Hutton speaks, everyone listens, they came out with a policy that was not like the traditional whole life policy. And again, we can leave this for another segment to really get into picking apart the difference between whole life insurance versus universal life insurance versus term insurance, because there's a whole bunch of varying different conversations and dialogues about that. But one of the potential drawbacks of whole life insurance that I think it's important to point out, it's a very great vehicle. That's the one that probably has the most history, is that it's somewhat a little outdated in that some of the folks are saying, I'd like to have something that's going to give me greater returns. And this is where E.F. Hutton came out with a universal life policy. Now, what's the difference? The difference between whole life and universal life is a whole life you're buying into a mutual company, which in effect you have an ownership stake in the business, and they pay you dividends. They give you a guaranteed rate of return, typically around 2%, which is not unreasonable, and then they'll pay out a dividend at the end of each year that they'll credit the account. Traditionally speaking, those can range anywhere from 3 to 4%. Where the universal life policies came in is that they actually were tied into an index, within the stock market. Now, here's what happened. In answer to your question, in the 80s, folks were going out and saying, okay, we have a tax loophole. Now, it's real important to understand why there's not a tax burden when you withdraw the money. Let's say you have a life insurance policy, and before we get into funding it and everything else, that you now have accumulated $5 million in there. When you pull the money out, you have to understand that it has a tax-deferred status in terms of the way the money grows. When you pull the money out, if you were to liquidate the account, you are creating a taxable event no different than a 401 or an IRA. So the trick, and this is where I look at people and I wink, and I basically tell them, is you pull the money out by way of a loan. It's your own money. Now some people think, well, that's silly. Why would I want to borrow my own money? My answer to you is because you can. And the bottom line is that you think about your 1040. We're talking about taxes now here, boys and girls, which simply means that if you go out and get a traditional loan from the bank, you're not going to claim it as income, right? Well, you're not taking out a loan from yourself and you've got all those gains and everything else within the policy. When you're pulling that cash out, it's a loan. And do you want to pay yourself back? Sure. Well, you know, in your early years, when you decide you want to quit working, well, you necessarily don't want to pay it back. But it's a loan that's still lingering out there, so it never goes on your 1040. And that's how you can do it. So going back to my comment about the 80s, a lot of folks were saying, okay, so I got that tax-deferred status. I can withdraw the money tax-free. Wow, that's pretty cool. So you had savvy investors who would go out, and insurance agents were loving it because they'd say, how much money can I give you $1 million? Now, you can imagine the answer. Sure, of course I'll take $1 million. How much life insurance do I have to buy? Well, it's not really specified. How's $100,000 sound? Now, I'm being a little facetious here, so people were all over it. Well, let me tell you, when something's good for the general public, it's typically not good for the federal government. So the federal government stepped in and they said, okay, what did they create? It's called tax reform. Tax reform basically means the public gets screwed. Sorry, but there's no way of sugarcoating that. So what they came out and said was, look, that's what we said, but that's not what we meant. So what they are now saying is, if you're going to dump X amount of dollars into a policy, you have to have a certain amount of life insurance above it. Herein lies the problem. I would say that 95% of the community out there, of both the financial planners as well as, and here's the sad part, the insurance people that are supposed to be experts don't know how to structure a policy properly because they're so used to selling death benefit. So what they do is they sell you monster death benefit and very little by way of tax accumulation. Or excuse me, not tax, but wealth accumulation. So this is where these concepts come in real powerful, and this is what might got your attention, is that we're saying, hey, look, what we want to do is we want to get as little life insurance as possible and throw as much money as we can in there.
Yeah, and we'll get into that as we go through these examples, especially into the higher dollar amounts. And I'll share my feelings about that, when we get to this point. But let's look at this first one. It is issued at age 32. Adding $1,000 a month. So why don't you walk us through this and tell us what this looks like?
Okay, this happens to be one of my favorite companies. I'm not going to say who it is, but if anyone in the business, they can tell by looking at it. And the reason why I like this particular company is because they have added benefits to the right. But let's just cut to the chase and look right at the numbers. Here's bottom line. Life insurance annual premium, what that means is that you're depositing a total of $12,000. That means $1,000 a month. The cash accumulation value, and you'll notice over to the top left-hand side it says issue age is 32, and then we're going to do a summary at age 60. Now, what that means is that we're going to assume that this individual here is now going to start making withdrawals at after age 60. So what this translates into now is a cash value accumulation is going to be $913,000, or annual tax-free income of $75,000 that he can start drawing starting at age 60 for the next 40 years. So that's almost like a guaranteed income of for 40 years, almost like an annuity.
And that's a loan to yourself, so you're not paying taxes on that.
Correct. So you're not paying any taxes, and as you're pulling money out, the money that's still left in there, remember, it's continuing to compound. So let's just continue going down. So let's say you live to be 100 years old. Now, that might seem a little far-fetched to you. Let me give you a little history. I'm pushing 50 years old, and I remember growing up as a kid. Actuary tables is a study what the insurance companies will use for underwriting to determine what people actually live to. In my day, when I was a little kid, the average age was about 72 years old. Give you an idea of what that looks like today. A little girl born today will live slated to live to 124. The centennials, which means the 100-year-olds, is the fastest segment growing of the population. So the likelihood of you living to be 100 is a lot higher than you might think. But let's say that if at age 100...
I just don't know if I want to. Sorry.
Well, you know what? It's quality of life, but with the advances in medicine...
I think about that. I'm like, I don't know if I want to be... Because if I'm 100, I picture myself barely able to eat in a home somewhere. I mean, not in a home, obviously, but... required care and sitting in a wheelchair looking out the balcony. I mean, I don't know. Anyway, I just think about that and I laugh because I'm like, that's okay, but do I necessarily want to be around at 100?
But and that's so true. But you know what's really amazing is remove the number from it, and it's really the state that you're in,
exactly.
Whatever that age is.
Right, and I picture someone who's 100 in there. Barely there.
But you know what's funny is that when I was a teenager, a 60-year-old, man, they were wicked old.
Yeah.
Today they're not.
Anyway, okay, I took a tangent, but okay, let's go.
No, but that's a good one. So most people think of it. So here's what we end up with. Let's say you croak at $100,000. There's no tactful way of putting it. So
100 years old.
Excuse me. That's it. See, I'm thinking money. I just can't get occupational hazard. At 100 years old, you end up passing away. Okay, I'm going to be a little bit more prudent. The remaining death benefit after income is that there's $853,000 that you can pass tax-free to whoever your heirs are. So let's move over to the right, and this is another way of looking at it, is let's say, God forbid, you get in a motorcycle accident because you're going through your midlife crisis at 60 when you retire. The death benefit is income tax-free at $1.2 million. Now here's what's interesting. Is the policy at $1.2 million? No. I wrote this policy, in this particular case, as small as possible, but we have an increasing death benefit because I'm expecting that portfolio to get bigger. So I want it to gradually increase to kind of give you that headroom, if you will. So that way you maintain the rules of maintaining that corridor in terms of having just enough insurance above it. And by the way, common question people ask, and you should be asking, is what happens if you push it too high? You end up creating a taxable event, which now gets treated like your traditional retirement account.
And what's you term that as MECing?
MECing the policy, which means you create a modified endowment contract.
Right.
And in simple English, as I said, that just means it gets treated like any other qualified plan.
And so when you set something up like this, you have to make sure that that's taken into account, and working with someone like yourself is the best way to do that. So
right, and one of the things, and here's where I'm going to put a plug, and for those of you that if you already have a long-term relationship with someone, either keep them honest or making sure that they're educated, is that the simplest solution is to take the path of least resistance, which is not the best solution, which means that they're going to sell you more insurance or add more insurance into it to allow for that, but then you're increasing your cost unnecessarily. So what I've done in this case is I've kind of put it on autopilot so it increases over time. The reason why insurance agents don't like to do that, again, I think in most cases they give them the benefit of the doubt because they don't understand how, but the ones that do will still take that path because quite honestly they make more money that way. And I just don't think that's right. I think it really needs to be done and it needs to be tweaked properly.
Cool.
All right. This is one of the reasons I think this particular tool is very sexy because not many of them will offer this. This is actually built into it. It has $1 million of terminal illness in there, so if you become terminally ill, you have access to $1 million of your money.
And that's liquid. Access to $1 million liquid.
Well, actually, this is to the actual death benefit as well. So even if you don't have $1 million in your policy, you get $1 million worth, up to $1 million worth of terminal illness.
Okay, gotcha.
Care. Yeah. Chronic illness, which means it's not terminal, but this is almost, think of this like a long-term health care. This in no way, shape, or form is supposed to be replacing long-term health care. That's a totally different conversation, but most people think that long-term health care is for the elderly. Believe it or not, statistics show that the younger you are, they're probably going to need it more because we tend to be daredevils. See how I'm saying we? I'm putting myself into that category. And then anything that's critical or life-threatening, there's another $1 million. This report, what I'm trying to do to keep it real simple so as not to confuse anybody, is this is a 38-page report that pretty much imagine lifting the hood from a car and looking at the engine and then getting a manual that explains every component. That's what this report does. It's enough to put anyone to sleep or confuse the heck out of them. So what I usually like to do is I like to go right to this sheet here to show you, the basic gist of it. And then we've created an actual spreadsheet that summarizes everything. And here's where it gets real sexy as we compare it against the traditional investments. This particular vehicle here they do have a guaranteed value of 2%. And I'm illustrating a rate of return of 5.99, which is, just under 6%. That's where we came up with the $75,000. Historically, even with these last few years have been terrible. The rate of return on this has actually been significantly higher. I don't want to quote that. I'd rather use low numbers, and again, just to be extremely conservative and prudent. So what you're looking at here, if you look at the left side of the policy, it says, policy year 17. We're kind of accelerating it up to the future. Let's go all the way down where it says the policy year is 28. That's age 60. At year 29, this is when this gentleman here that we did this for is now pulling out the money, and that's where you see $75,000. So if we go to the next page, you'll see that this continues on until they're 100 years old. Now this is a great page here because what I'm showing you is the everything that the illustration shows on the insurance side, but I'm also comparing it against others.
So you've got a municipal bonds here, certificate of deposit, mutual funds, IRAs.
Actually, let's go to the top because here's what I'm doing. I have a certificate of deposit.
Yeah.
What I have is the type. And I put tax type in terms of whether it's taxable, exempt or not. The interest rate of return. Are there any management fees typically with it? Any premature distribution fees or taxes, whatever, and then any kind of sales charges. CDs, as you know, are taxable. So that means as you're earning, you pay as you go. And a lot of people don't realize this, by the way. Same thing if you skip down to not the next line, but the one after, which is the mutual fund. It's taxable. So even if you're earning a really sweet rate of return, people seem to forget that you're paying taxes every year on it. So, but they only focus on the statement rather than realizing that they took money out of their cash flow to pay for the taxes. So going right back to the top of the page, you're looking at 3% rate of return, which I think is being very generous. A muni, as we call it, it's a municipal bond, tax-exempt bond of 4%. You'll notice across the board there aren't any kind of funny sales charges that are inherent with those. A mutual fund, it is taxable. I'm using a 9% rate of return, which is not unreasonable, although most people are in the red, but again, I'm being generous here. There is a management fee of 1%. For those folks that think, oh no, but I bought a no-load fund, look again. If you look at the prospectus and you look at it very closely, there are going to be management fees that are in there to manage the portfolio. It's not going to. When you buy a no-load fund, they normally take money. If it is a loaded fund, they take money right out of there. So, for instance, if it's a 2% service charge and you throw $100,000 in, your net deposit's $98,000. A no-load fund is not going to. It's going to be your $100,000, but to manage it throughout the year, they're going to hit you for 1%. So that's going to come out of your net rate of return. Also, an IRA, it's tax deferred. And I'm showing 8%, which if you look at most people's portfolio, they'll think if you ask them if they got 8%, most of them are going to tell you, I wish. And again, a management fee is 1%. All right, why am I doing this? Because I'm comparing it against something that's tax favored at 6%. You'll notice there the Secure Plus provider, that's the Index Universal Life policy that I showed you the illustration before earlier. Here's what we're looking at. We're making... this fellow's 32 years old. He's making $12,000 deposits, which you look at in the second column right there. It says net withdrawals or payments. In this case, it's payments. He's making $12,000 payments until age 60. At age 60, you'll notice in the red, he starts pulling out $75,000. Now, if we just go ahead and keep it right where it was, right there, thanks. You'll notice that with the CD, if you look at his age, with a CD, he's going to go into red, which basically means he runs out of money at age 66. More importantly, at age 65, he can't even pull out that $75,000. The likelihood of you living beyond 65 is pretty high. So if you're retiring at 60 and you wanted to take the safe road, quote unquote, and put everything in CDs, your money's going to last you 5 years. Not such a good deal. Municipal bond, that's going to last you, and you're going to run out of money when you're at age 68. And the $75,000, well, we'll call it age 68, 62,000, 75,000 is close enough. Now look at the mutual fund. That's the one with a 9% rate of return. You're going to run out of money also on that one. You're going to run out at age 70. The likelihood of you going beyond age 70 is real high. And quality of life, Mike, can actually be pretty good even at that point.
Sure, and definitely, and again, there's nothing to leave to heirs either.
Well, but let's just say, just for fun, that this wouldn't be fun. But I mean, let's say if you pass away at age 62,
sure,
you have 565,000, and then depending on your other assets, there's a big issue of estate taxes.
Right.
Which, by the way, we can definitely have another that's for another segment. Talking about estate planning.
Yeah.
But look at the IRA. The IRA. This is why they're big on IRAs, is because with the tax deferred status, it does work out a little bit better. And I even used a lower rate of return with the IRA, and look at your money lasts you just a tad longer. But again, at age 72 is the last year you can pull out any kind of significant income.
Mm-hmm.
Now look at the difference between the insurance policy. The insurance policy, you're able to pull out $75,000. If you'll notice over to the far right there, and actually, you have three different columns in there. The bottom line is you're in the black all the way till age 100.
Now these are the accumulation value?
The accumulation value would be under the assumption that you're not taking any money out.
Mm-hmm.
And you'll notice that with the actual deposits, that you're putting in there, here's the most important part. You have access to this money right away. So the $12,000 that this person's putting in right from the get-go, they may not have access to 100% of it during the, let's say, first 4 or 5 years, because what you'd have access to is where it says surrender value.
Okay, so that's what I could take a loan out for myself if I wanted to.
Exactly.
Okay.
But you'll notice, if you look at what year is that, right? Year 11 in this particular case, the surrender value and the accumulation value are actually equal.
Okay.
So that means there's your break-even point in terms of the actual accumulation.
Mm-hmm.
Now, some people think, okay, so that means it's going to take me 10 years to break even. No, not based on what you put in. That's actually around year 6 and year 7. So you'll make that up. Mm-hmm. So you want to talk about your cherry on top? Mm-hmm. Look to the far right.
Right.
Not only do you have that, but you also have 573,000. So go back up. If you go back to the first year, again, I want to structure this where they have as little life insurance as possible. So in this particular case, we have $425,000. This is a small policy. I didn't do this for the life insurance. I did this for the cash accumulation to guarantee this person can pull out $75,000 a year, basically for the rest of their lives.
Now let's look at the fun part down at the bottom.
Okay. You mean the higher numbers?
Well, yeah, exactly. So this is age 60, which means I could start pulling out $75,000 a year,
right?
All the way till year 100.
Which means, okay, go ahead.
No, I'll let you finish up.
Well, here's the interesting thing. A lot of people don't realize this. Look at the black number right underneath that last red $75,000.
And that's $2 million, not 2,000.
That's $2,600,000 that you've pulled out throughout your lifetime, assuming you live to be 100. That's not a bad deal. Mm-hmm. So, compared to what? Being in the red. And then whatever's left over, you can then pass on to your heirs. Now, you'll notice that one of the things I did point out is that I have increasing death benefit, but you'll notice that on the far right-hand column, where we have a policy of, showing like $1 million and change in terms of, there it is, $1 million and change of death benefit, it starts to go down.
Right, because you're pulling money out.
Because you're pulling money out.
Right.
That's the only point I wanted to make.
Yep.
Now, you've seen what the summary page looks like, so there's no need to go into the other examples. Let's make this real sexy, all right? A lot of folks don't think, $1,000 a month, oh yeah, piece of cake, no problem. $2,500 a month, most people still think, yeah, no problem. Let's look at $2,500 a month.
Well, let's actually, for time's sake, we got about 45 minutes left.
Yep.
You want to jump up to the 5 and the 10?
Let's do it.
Okay, so here is the summary for someone who's depositing $5,000 a month or $60,000 a year.
Exactly. And just for simplicity's sake, because I don't want to overwhelm everyone with a whole bunch of reports and different pages, the very first document that I showed you, which is a summary page from the actual insurance company, it's going to look identical, whether it's $1,000 a month, $2,500 a month, $5,000, what have you. with the exception of the numbers, of course. So you've already saw what it looks like. What I've done is I'm giving you here basically the bottom line. So if you look at the very top, there's no, it's the exact same scenario. The only thing that we're doing different, as Mike just pointed out, is that now we're depositing $5,000 a month or $60,000 a year into this account. What that means is that if you look at line 41, the income now, instead of $75,000, now boosts up to $375,000 for the rest of their life. As far as when they run out of money, what's interesting? It's the exact same years because we're pulling out money. So it's no different. You're into the red. If you use a traditional way, you run out of money. You're completely broke by the time you're 72, even in the best case scenario. In this particular case, you ready? $13 million you get to pull out. And I'm using a 5.99 or 6% rate of return.
So, and let me ask you real quick on this question, because obviously, someone's probably wondering, what does that $65 million mean? So that would be the accumulation value of the account. So correct me if I'm wrong, but if I decided not to pull any money out, let's say I already had other investments and I was already taken care of, by the time I die at 100, I would have $65 million essentially sitting in that account.
Uh-huh.
Okay, so that's what we talk about when it comes to leaving a legacy, and we'll talk about that in future sessions as well. How you really set your heirs up to become quite wealthy, especially if you teach them the stuff that we're teaching in Elevation Group and these methods. So
that's exactly right. One of the things that you were mentioning, Mike, is what happens if you had assets, other assets, and you didn't want to touch this. Let's compare that to, let's say, the best case scenario using the traditional, and we don't have to highlight anything, but if we were using like an IRA or 401k, you have to touch that money. You don't have a choice. The federal government says that by age 70 and a half, they're going to now take, based on what they feel, how long you're going to live, and they're going to have required minimum distributions.
Mm-hmm.
So they're going to tell you have to pull that money out. Why? Because they've been holding off on their taxes.
Sure.
They want to get paid.
So this can continue to accumulate through generations indefinitely.
Right. Exactly. And this is why the Donald Trumps of the world, and Donald Trump is considered to be new money, by the way.
Sure.
This is when you start going into the Rockefellers,
Yep.
the Rothschilds, and, families like that. And that's when they've seen the power of something like this.
All right, so let's take one more example and look at $10,000.
Well, and you'll notice that the last one we said was $375,000. Now we're doubling the amount. There's no magic here, guys. Now we're up to $750,000. So you can almost pull out your calculator and do the same for yourself. So if you want to figure out what $2,500 is, or $2,000 is, or $1,500 a month is, you can just do it proportionally speaking. And that's how you come up with your numbers. In this particular case, look at, putting $10,000 a month in the scheme of things may sound, it's more doable than you have any idea. When you're putting $10,000 a month, you're pulling out $750,000 in income for the rest of your life.
Every year without taxes.
Without taxes. And you're looking at $26 million that you're actually pulling out. I feel like I'm doing a Ginsu knife commercial, and that's not all, but it's true.
Sure,
this is mind blowing.
And look at what you can pull out as well to start borrowing to, start a business, pay for land. I mean, when you're hitting these numbers around here, you don't need to ever use a bank for anything else again. You're simply paying yourself and borrowing from yourself.
This is how you create the bank of you. And you'll notice in the aspect where I got into this long-winded description about what the bank of you was, banks move money. They don't leave it sitting idle. They try to get depositors to do that, and they pay you a meager interest. Why? Because they make money on use of your money. So what we're trying to get across to you folks here is that you hold on to your own money, but it's not a matter of just let it sit in here. Because this is showing you a rate of return of 6%. Does that mean I'm going to tell you don't touch it? Absolutely not. Do what the banks do. Use it. Use this as a repository. Whenever you have extra money, you throw it in here. If you're going to go out and buy that car, borrow it from yourself. Then now you're paying yourself the interest, which is income, which you don't have to pay taxes on. If you want to go out and buy a piece of real estate, borrow from yourself. You're doing the exact same thing. Do the note no different than you would any other way. The difference now, though, is that when you take out a note for yourself, again, you have all the same benefits. You're paying it to yourself. So you're almost like you're having your cake and eating it too, 100%. And this is the secret. Think about it. Is banking a profitable business? That's not a trick question. You know the answer to that question. Banking is a very lucrative business. And how do they make money? It's by basically is moving that money, and that's an understanding how the principle of money and how the banking concept works. And that's all we're showing you folks is how to do that.
Cool. So, what really excited me about this first vehicle or first instrument, I've chosen to set this up personally, is the many benefits that it provides, but it provides that foundation. So, theoretically, if I'm investing $10,000 a month into this, I can pull out $750 a year when I turn 60, and the government can't take it away from me. If I get sued, people can't take it away from me. I don't have to pay taxes on it. And so at that point, I'm done. And from an entrepreneur's perspective, I really like the idea of the security that provides. It provides me with the kind of lifestyle that I would want, the security that I would want, and at that point my retirement's done. And I can go, swing for the fences, pursue any business ventures I want, be as risky as I would like to be over the next 30 years.
Guilt-free.
Guilt-free, without having to sweat bullets come, when I get into my 50s, there's a lot of people out there and guys in their 40s that are freaking out and being like, man, I'm not in the place I need to be when it comes to my retirement. And they're sweating bullets. And I wanted to make sure that I wasn't in that position because I don't want that kind of stress in my life, especially in those years. That's when you want to kick back and relax and enjoy things. But at the same time, I'm an entrepreneur. I want to take risks. I want to pursue businesses. So how do you take care of that? And this, to me, was the perfect vehicle to do it with. And man, it just makes total sense.
And see, this is one of the reasons, Mike, that I was somewhat insistent about using the cash flow model, because the one common denominator I've seen with serial entrepreneurs is that they always forget to pay themselves first.
Mm-hmm.
They're visionaries. They're very passionate about what they do. They're fantastic creatively, and they can go out and create these businesses. They'll go out and make a multi-million-dollar business. They're driving Lamborghinis one day, and then the next day they're out there waiting tables because everything kind of went into the toilet.
Sure. Google AdWords decides to shut your AdWords account down, and you're screwed at that point, and you have to reinvent the wheel. And I have a feeling that there's going to be a lot of people out there who are, when you hit your 50s, aren't going to want to reinvent the wheel anymore. It's just not a fun place to be. So
no, and again, I mean, and you know what? I got a confession to make to everyone here. I'm a classic example of this. I'm gonna be turning 50 over here. I've been swinging for the fences, but you know what my saving grace is? I did this, so I have my safety. My whole safety has been covered.
Yeah.
I'm protected, and that's what allowed me to go out and take the kind of hit that I took. I took a $10 million hit. It happens. You know what? But my attitude is I can go out and make 2-3 times that. But that's a nice position to be in, to be able to do that.
Sure, and not have to worry about it.
Well, that's
awesome.
I can sleep.
Yeah, that's awesome. So guys, this is one of the foundational episodes for the Elevation Group, and we're going to be doing many more with Paul. And I really appreciate you coming out today, Paul, to do part 2 with us and go through the numbers, because this is obviously where it gets really fun and interesting, and it really becomes real. Talking about concepts and theories is, I mean, I'll speak for myself. Frankly, it's kind of boring when it comes to financial stuff.
It's very boring.
But when you get into the numbers and you can actually see the prize at the end of the road, it becomes really, really exciting. So, thank you for sharing this with everybody. Thank you for coming up with all of these examples. And guys, if you need to get in touch with Paul, if you have questions for him, if this is something you'd like to set up, his contact information is going to be in the members area, and so feel free to do that. And I'm sure we'll see you again soon.
I'm looking forward to it.
Awesome. Thank you, everybody. Take care.